And we go on with our program with Patrizio Lainà from Switzerland. Basically, we asked him because he did so much research on monetary Finland. Sorry, what did I say?
Switzerland.
No, Finland.
Let's get that right.
Even the Dutch are sometimes bad at geography.
No.
He did a master's thesis and a PhD thesis on monetary reform and anything that has to do with the Chicago plan. And basically, we asked him, to give us an update on the state of affairs of research and also ideas about what further has to be researched. And Patrizio, very nice to see you. It's the first time I think we meet, digitally face to face. I'm very glad you took our invitation. The floor is yours.
Thank you. It's an honor to be here. Thank you for having me. And yeah, I'm from Finland, not from Switzerland. But anyway, yeah, I wrote my PhD on monetary reform a couple of years ago, and after that, I've been a trade union economist and haven't done any research on monetary reform ever since. So perhaps my update on the most recent research isn't up to date at the moment. But of course, I try to follow what I can, what happens in the area of research. I'll try to share my screen. I hope you see my presentation. So I'll try to go through what I've done in my research and also how it's related to the research of others. As well, I'm also trying to go or present what I think that further research needs to be done, or at least needed to be done a few years ago. I'm not sure if somebody has already done at least part of that research. So this is the outline. I have quite a few slides here. I'm not sure how well I'm able to go through these, but I'm just trying to give a glimpse what I've done. So first of all, I've done this history of monetary reform proposals, and before going to the proposals, I just want to define what I mean by full reserve banking. My PhD was titled Full Reserve Banking, Separating Money Creation from Bank Lending, and I use full reserve banking as an umbrella term, so it's a catch-all term, and basically what I mean by full reserve banking is that the subtitle of my thesis, separating money creation from bank lending. So basically the money supply will consist of government money or commodity money as well. So it's quite an extensive definition, and private money creation is prohibited in the sense that government does not guarantee repayment or par clearance of any private money like assets or like deposits. So there's no deposit insurance or lender of last resort. So central bank is not the lender of last resort to banks. Of course, it can be a lender of last resort to the government. So the idea is that private money is not backed, but of course, money like assets can be created. I think that cannot be prohibited completely. But the idea is to separate government money with what is like safe money and what is not. But this is what I mean or cover with full reserve banking. Sometimes full reserve banking is used interchangeably with the Chicago plan, but I mean all these types of proposals covering sovereign money, deposited currency. This is, I wrote my PhD a few years ago. No, of course, the writing process was done mainly many years ago. So nowadays, deposit currency is known as central bank digital currency, so CBDCs. But James Tobin used this term deposit currency when he made first these type of proposals. I'm not going to go through all these, but just trying to show you that that's what I mean by full reserve banking is quite extensive, and maybe not always how it's understood in the literature. But this is mainly the history of full reserve banking proposals. So I guess Ronnie Phillips was here as well, and I thank Ronnie for all mainly pointing me to this research. So David Ricardo was probably the first one who proposed full reserve banking. Then there was, of course, the Chicago Plan, Glass-Steagall Act, what was the watered down version of the Chicago Plan, as you can find from Ronnie's book. It's an excellent book.
Patrizio, I'm going to interfere here. I've got some remarks already about the size of your slides. If you can put it into a larger format.
Okay. Okay, because this is short.
Or remove the notes on the side. You could remove or hide.
Okay. Can I? No. Not from there. Is it any better? No.
Top right has also a button for small and big. Or this might be just the setup of the presentation. Then otherwise, folks, there is a view options on the top of your bar where you can choose between fit the window 50% or 100% original size. And then you can slide a little bit your screen.
Now, is it now?
It's good now.
It's good. Okay. Yeah. Okay. Yeah.
Right.
This is.
Sorry about that. Let's continue. We'll edit.
No, yeah. Good to point out that, because this is some features of Zoom that I don't like really much. But yeah, I was in the Chicago Plan, and then of course there was sovereign money types of proposals by Jackson and Dyson, and of course after the global financial crisis, it also went to the policy agenda. But what's the situation at the moment is that a full-fledged implementation of full reserve banking is very unlikely in the near future. I don't see any possibilities for that. But however, this deposited currency or CBDC version of full reserve banking is quite probable, and actually it's already been implemented in some countries. I'll come back to this later. But this is what I tried to summarize all the general findings from the literature of others. So this is basically a literature review of what comes to economic stability and what the arguments for and against economic stability and full reserve banking are. And I'm not going to go through this very in a very detailed way, but basically my assessment is that the literature gives generally a positive impact on economic stability. So full reserve banking has generally a positive impact on economic stability. And then what comes to democracy, full reserve banking is typically supported in surveys. If you ask people who should create money, people usually answer that the government should create all the money and not the banks. But so basically, full reserve banking has quite a support from surveys, but we know that actually it went to referendum in Switzerland and it wasn't passed, so it's not that obvious that it's always supported by the people. But anyway, I also assess generally that it would have a positive impact depending on different factors on democracy. Or at least it's something that democratic society would like to strive. And then what comes to social equality, of course, new money could be distributed more evenly. There will be any risk-free returns after full reserve banking is implemented. But then again, there's also, I think, quite convincing arguments that there isn't a very large impact on income inequality. So my overall assessment is that maybe full reserve banking has a slightly positive impact on social equality. And then also I assess how ecological sustainability what's the impact on that? And well, there's very large literature on whether there's a growth imperative or not. I will say that there's a nominal growth imperative in our current monetary system, but no real growth imperative. So basically, we don't necessarily have that, and also how money is created is not necessarily that much affected, or investments are not that much affected. So the general assessment is that full reserve banking doesn't have any impact on ecological sustainability. So this is basically how I summarized the research of others. But this is something that I also I have a working paper on this, and also this is included in my PhD thesis. Sign-and-Rush revenue, how much sign-and-Rush would full reserve banking generate. I calculated how much the transition to a full reserve banking system would mean. So basically there should be reserves should equal demand deposits. That's basically how I calculated this. As you can see, the US, there will be any transition sign-and-Rush. I'll come to that later. But this is, and in other countries, UK, Euro area, Finland, it's up from 30 to 55%. If you look at the or compare to GDP, but this isn't really important. What is more important is how much annual sign-and-Rush revenue does full reserve banking generate. And basically, I calculated it that if money creation will continue in its historical path, so M1 growth rate will be the same in the future. So how much income will that generate for the government? And it depends, of course, how big is the demand deposit, how big is the money supply, and of course how fast it has grown historically. And then the sign-and-Rush revenue varies from 1% in the US and to almost 8% in the UK. So these are quite significant numbers if you compare, for instance, to the general government budget or the central government budget. So it's already 20% of the general government budget of the UK. And I guess this is quite very well in line with other research on this sign-and-Rush revenue. I guess if I recall correctly, Michael Kumhoff has also reached this sort of results. Okay, this is another thing that I've done, stock flow consistent modeling. So basically, when I started my PhD, and I can add now that I consider myself as a post-Keynesian economist, and when I consulted researchers who have done stock flow consistent modeling, for instance, Mark Lavoie and others, they all argued that, okay, full reserve banking is not compatible with stock flow consistent modeling. You cannot do that. But then I was able to do it, and in the end, I guess Mark Lavoie was complimenting me that, okay, congrats for doing this. But basically, it's a post-Keynesian model. It has 80 equations, and it was published in Cambridge Journal of Economics. So if you want to look at the model, you can check my paper, and I'm not going to go through it. I'm just showing you, if you like to do stock flow consistent modeling, then you're familiar with this type of table. It's a balance sheet matrix, but I'm not going to go through this. And these are basically the simulation results. I'm showing that what differs, and this is the findings, the overall findings. So basically, output, employment, and inflation evolve very similarly under full reserve banking and the current monetary system. And the reason is that what matters are the transactions and flows of money, and not what is the monetary system, underlying monetary system. So this is basically the reason these are evolve very similarly. But then again, fiscal space of the government is increased under full reserve banking, of course, as the government will have a sign-and-Rush income or sign-and-Rush revenue from money creation. And one of the arguments is that full reserve banking would cause very volatile interest rates, but this is not true according at least to my simulations. On the contrary, interest rates behave quite smoothly, and the changes are also quite small. Okay, and then well, there's also if money is created in different ways, how it affects, but it doesn't have really an impact, except that if you're creating money through quantitative easing, it doesn't affect the real economy, only monetary aggregates. And well, that should be obvious, as of course, just creating new money to repay government debt doesn't create any new transactions in the real economy, so that of course doesn't have any impact on the real economy. And credit crunches, they are possible, but they are also quite rare in this model, at least. But this is only a theoretical model, of course, and doesn't give a final verdict. We need, of course, empirical evidence to have something to really say about full reserve banking. And this is maybe a bit surprising that the US is already running a full reserve banking system today, at least on the aggregate level. So there's more reserves than demand deposits in the US, or at least was. This data is from, I think it ends in 2014, but I guess after all the QE programs and even after tapering announcements, this is still the case in the US. I haven't checked it more recently. But as I said, that the US only runs on full reserve banking on the aggregate level, so basically there's more reserves than demand deposits, but full reserve banking is not required, not requirement in law. So basically there can be differences between banks. So each bank is not running a full reserve banking system, of course. So no country runs a full reserve banking system today in the world. So does it mean that we have no empirical evidence on full reserve banking system? How does that affect the real economy? Well, this is not the case. Full reserve banking was experimented in the 19th century in the UK and US. The Bank Charter Act in the UK implemented full reserve banking that required bank issued notes to be fully backed by government money or gold. And in the US, the national acts implemented the same thing. And what happened is that, of course, there's not that much data available, but what we know is that at least macroeconomic indicators either stayed quite stable or then pointed upwards after the experiments. So we are quite confident to say that at least the economy did not collapse after implementing full reserve banking. It is much harder to say that what is the cause and what is the effect, but at least I think we are quite confident that full reserve banking did not mean that the economy would collapse, as sometimes is presented, that there won't be enough money. And this is just to show what we have data on the UK. 1844 was the year of implementation, and as you can see real GDP growth actually peaked in that year, and inflation picked up a bit after that, but then also although inflation was quite volatile at the time, and there was also 15% inflation rates a decade before implementation, so inflation also behaved quite, I would say, normal by the standards of that time. Okay, so what is needed in the future? What's the further research that needs to be done? At least I think conceptual consolidation is one of the key things that needs to be done. I used full reserve banking as a catch-all term, but sometimes it's used interchangeably with the Chicago plan, and it's not clear what full reserve banking always means. Then there's other terms, debt-free money, But then again, you always delve into the discussion, what is debt and what is money, and can money ever be debt free? And if you look at that, if it's only a liability of some sector, then it's never debt free, and so on and so forth. And this is actually the reason why I used separating money creation from bank lending as a subtitle of my PhD thesis, and not debt-free money, just to avoid all these kinds of discussions which do not take us anywhere. And then will be much simpler to talk about government money or public money. But of course that would exclude all the commodity standards. So full commodity standards, gold, like 100% gold standard or something like that. But it wouldn't be necessarily a bad thing, because this is quite. It's not very clear, but usually what will happen, and the proposals also differ quite a lot, whether you have a commodity standard or these other types of what I call full share banking. But this is something that needs to be done. Conceptual consolidation, what we mean by different terms. Okay, and then I will say that this is perhaps a very interesting thing that needs to be done. We need to model international aspects. We have quite extensive theoretical and formal models already available on full reserve banking, how it behave, how the economy behaves, but the focus is on domestic aspects. I haven't seen a model that really looks at the international aspects, and we do not know even in theory or in formal models how the international political and economic or business community will react to such proposals. Practically, we have no research available. We have some discussion and guessing what will happen, but not really any rigorous research on that, not even theoretical or formal research. And of course, it depends quite a lot on beliefs, but what will happen, how different actors will react to these kinds of reforms. I would guess that international political community might be maybe receptive. For instance, IMF and the central banks have welcomed central bank digital currencies, so there's some tolerance there at least. But then again, if one country would like unitarily implement this kind of reform, there might be some kind of counter arrangements by other countries. So it might be seen as a challenger of the current monetary system. So it's not that clear how the international political community will react. And then how the international economic community or the business community, will it be hostile? Maybe it might cause unjustified fears of nationalization among investors. Of course, and I'm saying unjustified because, of course, Milton Friedman was not arguing for full reserve banking in order to nationalize the means of production. He was arguing that we can regulate, or we can drop most of the regulation of banks after implementing full reserve banking, and we will have a freer economy. So that's basically the argument. And I haven't really seen anybody to argue that we need to do this in order to nationalize everything else. But of course, if investors believe that is a genuine risk, then it's also it is a risk for the economy, which decides to implement this sort of reforms. But on the other hand, investors could also see a country that implements this type of reform as a safe haven. The money will be very secure, no bank runs could occur, and so on and so forth. So it also might have a positive impact in one sense. But we don't know. This is something that needs to be done, and I think this is something that should be done now. And finally, empirical research. Theoretical research can never provide a final verdict, so we need some sort of experiments. This is basically what I'm arguing in my PhD thesis as well, that we need experiments and in order to see what happens if we implement this type of reform. We have data from the 19th century experiments in the UK and UK and US, but the data availability and reliability is not that high, as well as validity. How well does those results reflect the economy in the 21st century? Not that well, probably. But at least we have central bank digital currency experiments in the coming out, so we will soon have more data on this. Of course, this is not a full-fledged implementation of full reserve banking, but a partial implementation, but that might also have an impact. But so I encourage everybody to do empirical research on that when we have data on CBDC experiments.
Patrizio, may I suggest we stop here, because then we
we stop here. This is where I wanted to stop anyway. So this is the literature.
It's good that you have your literature there, which can also be found on the page of our conference, where I have the links also to your work. You can also find it on the extensive bibliography on the website of the Alliance for Monetary Justice. We'll go to questions, and I'll just have one very quick one, which came from Sue. In your list of experimentations or proposals for what you call full reserve banking, you left out the NEED Act. And of course, we in America, we're like, why did you leave that out?
Well, I'm sorry. I just wanted to briefly summarize some of the proposals that have been made recently, and just to give you a glimpse that what has been done. But of course, the NEED Act should have been included in the list. I'm sorry for that.
Okay, we're satisfied. I think next is Joseph Huber to engage you. Joseph, go ahead and unmute yourself.
Patrizio, I agree with very many things. In very many respects, what you say. At the beginning, I thought I had just one brief remark, but now I have three brief remarks. The first is on, you said in a full reserve system, there is the disadvantage or the threat of a credit crunch. And my response would be, you see, credit crunches can occur in whatever monetary system, because it depends on the preparedness of actors to lend or to invest and so on. The question is whether there is enough money, whether the stock of available money, of liquid money, is big enough. And in a full reserve system, if the central bank or whoever is issuing the money does a good job, there will be no lack of money. Whereas in the present bank money regime, when they are not prepared to extend credit, then you have a shortage of money as well. The second remark is the chart you showed on the excess today of central bank reserves over bank deposits. You know, that's functionally, seen from a functional aspect, that's a bit misleading, I have to say, because you see, banks simply do not need that much reserves. They came to the banks unsolicited because of the monetary policy of quantitative easing. The thing is that non-bank monetary institutions have sold a lot of their bonds and so on, their sovereign bonds, and the central bank pays for it with reserves, and the reserves have no other way than to end up in a central bank account of banks. And that's simply the reason. In the euro area, it's even a big disadvantage for the banks now, because the European Central Bank imposes negative interest, which is actually a serious burden on the banks. And so you see, well, that's a problem. And finally, you said we had a gold standard in the 19th century. We didn't. Sorry, we had a full reserve system, but I think you refer to the gold standard. But the gold standard is not a full reserve system. And it was never fully implemented, by the way. Private banks, for a very, very long time, through to the 20th century, were able to create bank money. And the gold standard was suspended several times and so on. But basically, a full reserve system there is a freely creatable fiat money, and that's not a gold standard. Thanks.
Patrizio, respond to that, and actually then we'll finish this session. And I asked Joseph then to stay on because he's the next speaker.
Okay, very good points, and I mostly agree. First of all, what comes to credit crunches, of course, they can happen in every monetary system. Of course, this is something that the monetary authorities need to look at carefully, very carefully, that not to create a credit crunch, of course. And this is an issue of monetary policy, how monetary policy is conducted. And I think that Michael Kumhoff has made a very good point that the money supply doesn't need to, even under full reserve banking, that the money supply need not to be set the amount of or the quantity of money, but you can also make money endogenous in that system. So the central bank can provide credit lines to banks in order that the money is relent to the real economy. So that's also possible, and this is I think the most or the best answer for this, that credit crunches are not something that we will see under full reserve banking if we want to conduct monetary policy in that way, or at least in the extreme case that we only set the interest rate and not the amount of money. And then what the US has more reserves than demand deposit, and I completely agree. Basically, why I wanted to show you the figures is that I would argue that the transition to a full reserve banking system will be quite straightforward in the US because there's so many reserves. It will be very hard to go to this kind of system, and this is why I wanted to show it. But of course, there's no legal requirements, and the banks do not need the reserve and so on. I completely agree. And then what comes to the that gold standard is not a full reserve banking system. Well, I somewhat disagree here, because if it's like a 100% gold standard, then it is a full reserve banking system. I refer to those proposals as pure commodity money type of proposals, but then again they are quite different from other proposals, and I think that in the 19th century the bank notes that private banks issued private bank notes, that was the dominant means of payment, and after this legislation, or after these acts were implemented, it required that all these private bank notes need to be backed by either gold or then government securities. So government debt was also something that could back this the private bank notes. So in that sense, I would argue that yes, it was a full reserve banking system, but then again, banks were quite clever and quite innovative. They started to issue demand deposits, and we know that the dominant means of payment are demand deposits. So this is the system that we actually created in the 19th century globally.
Patrizio, on that clear note, let's finish here, and thank you for the presentation. I think you're setting the what I call the epistemic standards pretty high in evaluating the proposal of full reserve banking or sovereign money. That's always welcome. You know, the higher we set the bar, the more clear and the more strong we can make our case. I don't think it will fall if we set the standards very high, but it's good to have a high epistemic standard. Anyway, thank you so much. We will spread the word and get people to your research. And yeah, thank you so much for participating.
Many thanks.
Go ahead.
Many thanks for having me. Have a great conference.
If this video was helpful, please hit the like button, subscribe for new video notifications. Please consider donating at monetary.org/donate. Don't forget to check us out on Twitter at AMI Monetary or on our website